Welcome to The Pulse from 10-Minute Money Mindset. This week, Mind Over Money explores a cognitive bias that explains why waiting on a financial signal, any signal, can make your decisions worse than the signal itself. This episode is the story underneath that. On April 29, 2026, the Federal Reserve held its most divided vote in 33 years. What that vote means and who pays for it is what we're covering today. Let's get into it. This is The Pulse from 10-Minute Money Mindset. Every Monday, the week's most important financial story. Named sources. Real data, no frameworks, no solutions, just the truth of what is happening and why it matters. The 30-year fixed mortgage rate was 5.99% at the end of February. By the week of the Fed's April decision, it had climbed to 6.38%. That move happened in less than 2 months. Not because the Fed raised rates. The Fed has not raised rates. It happened because the war in Iran pushed oil above $100 a barrel. Inflation expectations moved higher, and mortgage rates track those expectations more closely than they track the Fed's actual decisions. The result is a housing market that has stopped moving. Michelle Ranieri is Vice President and Head of U.S. Research and Consulting at TransUnion. She described where millions of existing homeowners find themselves with 2 words: feeling stuck. Stuck means you bought a house in 2020 or 2021 at 2.75%. You might want to sell it, you might need to move, your family changed and the house does not fit anymore. But selling means buying a new one at 6.38%. On a $400,000 mortgage, that difference is more than $600 a month in additional interest costs. Every month, permanently. So most people who could move just stay, and the people who never bought, the first-time home buyer has watched the window open and close twice in 18 months. Rates fell towards 6% in December. Then oil, then Iran, then 6.38. The house prices did not fall while they waited. The median home sale price in the second quarter of 2025 was $410,000, according to the Federal Reserve Bank of St. Louis. It was $317,000 in 2020. The people who waited for cheaper borrowing costs watched the asset they were waiting to buy get $100,000 more expensive while they waited. Joseph Yoon is a consumer insights analyst at Edmunds. In the first quarter of 2026, the average monthly payment on a new car hit $773, an all-time high. Buyers are getting squeezed from both ends, Yoon said, high sticker prices and high interest rates, neither letting up. Until the rate picture changes, buyers will keep stretching loan terms to make payments fit, which only adds to the total cost. Matt Schultz is Chief Credit Analyst at LendingTree. On credit cards, the average annual percentage rate has stayed just under 20%. Without rate cuts, there is not much reason to expect meaningful declines anytime soon, he said. Carrying a balance will remain very expensive. These are the people waiting on the Federal Reserve, not hedge funds, not derivatives traders. People with mortgage payments and car payments and credit card balances who have been making financial decisions or not making them, based on a signal from one institution. On April the 29th, that institution voted 8-4, and the 4 did not agree on anything except voting no. Governor Stephen Moran voted against the committee's decision because he believes rates are already too high. Moran has dissented at every single FOMC meeting since joining the Board of Governors in September 2025. On April 29th, he voted for a quarter-point cut. He believes the economy is being held back unnecessarily. 3 other members voted no for the opposite reason. Beth Hammock, president of the Cleveland Federal Reserve. Neil Kashkari, president of the Minneapolis Federal Reserve. Lori Logan, president of the Dallas Federal Reserve. They did not want a rate cut. They did not even want the language in the committee's official statement that hints one might eventually be coming. The Fed's statement included a phrase about carefully assessing the timing of future adjustments to the target rate. Hammock, Kashkari, and Logan found that phrasing too optimistic. With oil above $100 a barrel and inflation above the Fed's 2% target for the fifth consecutive year, they believed this was the wrong moment to imply that easier money was on the way. One member of the same institution believes rates should already be lower. 3 members do not want the institution to suggest that rates might come down. And the 8 who voted to hold are in the middle, trying to keep the whole thing from splitting apart. JP Powers is Chief Investment Officer at RWA Wealth Partners in Boston. He has been watching the Federal Reserve for decades. His response to the vote was measured and direct. Over 30 years since there have been that many dissenters, he said. Pretty crazy time. In the minutes after the announcement, traders began pricing in the possibility of a rate hike sometime in the next year. A hike, not a cut. The CME Group's Fed Watch tool showed a 25% probability that rates go up from here. One day earlier, that number was 0. Kevin Warsh is about to become the next Federal Reserve chairman. On the morning of April the 29th, the Senate Banking Committee approved Warsh's nomination on a 13-11 party line vote. The full Senate is expected to confirm him the week of May 11th. Powell's term as chair ends May 15th. The next FOMC meeting begins June 16th, Warsh's first meeting. At his Senate hearing on April 21st, Warsh told lawmakers he takes his responsibility to be an independent leader of the Federal Reserve very seriously. He also said inflation is a choice, and one the Fed must be accountable for. He wants to change how the central bank measures inflation, arguing that one-time price shocks like those driven by the Iran conflict should be stripped out to reveal the underlying trend. President Trump, in a CNBC interview on the same day, said the United States should have the lowest interest rate in the world. He said he would be disappointed if a Warsh-led Fed did not deliver lower rates. Jerome Powell described the economy as quite resilient at his April 29th press conference. First quarter GDP came in at 2%, a recovery from the weak 0.5% expansion in the prior quarter. The economy, by Powell's read, is strong enough that the Fed sees no urgency to act, which means the people waiting continue to wait. Neil Dutter of Renaissance Macro assessed Warsh's starting position plainly. The power of the Fed chair is the power of persuasion, he said. Warsh has his work cut out for him. Jerome Powell announced he would remain on the Board of Governors for a period of time to be determined. He said he is waiting for a federal investigation into cost overruns in the Fed's own Washington headquarters renovation to reach transparency and finality. The man who ran American monetary policy for nearly a decade is staying in the building. As a board member, watching what comes next. The institution tens of millions of Americans have been waiting on just revealed that it cannot agree on what comes next either. 8-4, 33 years, a new chair in 6 weeks, and the open question of whether the next move is a cut, a hold, or something no one priced in 48 hours ago. On Friday, Mind Over Money looks at the psychology underneath the waiting. There is a specific cognitive mechanism, a named bias, does, that explains why people make systematically worse financial decisions the longer they wait on a signal that keeps shifting. Once you see it, you will recognize it in every financial decision you have delayed in the last 2 years. That is Friday on 10-Minute Money Mindset.